Do you find yourself inheriting a significant amount of money from your parents, but unsure about the tax impact? If this is you, you're in the right spot. Whether it's real estate, stocks, life insurance proceeds, or maybe even retirement accounts, many don't realize the various tax implications that are associated with inheriting different types of assets. So today we're going to break that down, asset by asset, so that you know exactly what to expect when you inherit from your folks. Hi everyone, I'm Jordan Curnutt, a certified financial planner with Quantum Financial Planning, and I can't wait to dive into this often misunderstood concept. By the end of this video, you're gonna have a clear understanding what to expect from a tax perspective for each different type of asset that you inherit. And be sure to stick around to the end where we do a live mock demo of inheriting $1 million, but look at two different asset classes and just how that impacts the ability of the person in our scenario to retire early. So the first thing you need to understand when we're looking at this situation is there's two different types of taxes that we need to be aware of. If you start out by just doing a generic Google search for what type of taxes to expect when you inherit from your parents, what you're going to come across first and almost exclusively is this thing called estate tax. The first one we're going to look at is the federal estate tax. Now, as you can see, the estate and gift tax has something called a lifetime exemption, and it's a really big dollar amount. If you're under $13,990,000 for the tax year 2025, you're going to be exempt from any federal estate tax. And what I mean by this is we're looking at the net worth of your parents, who we're talking about inheriting from in this scenario. So what your net worth is we look at what you own. So we look at your assets, we add all of those things up. Then we look at what you owe. So a mortgage, a credit card, anything like that. And then that gives us your net worth. And if that dollar amount is less than this $13,990,000, then from a federal perspective, we're looking at no estate tax. If you do find yourself in a situation where you're above that threshold, the rate that you will be taxed is only on the amount above and beyond that, let's call it 14 million. It starts out a little bit lower, and then after about $1 million, it gets to its highest rate of 40%. Now, the second piece of the estate tax that you need to be aware of is at the state level. So the federal limit is pretty high for the vast majority of us, but at the state level, if your folks do happen to be residents of a state that is impacted by state estate taxes, then you do need to be aware of this too. So for instance, I live in the state of Washington, and here our exemption amount is about 2.19 million. And again, what this means is if you're under that dollar amount, you don't have to worry about any estate taxes in the state of Washington. If you're over that dollar amount, then we do start to see an increasing rate imposed as you get further and further above that limit. One other thing to be aware of, if you're watching this video, could be too late, honestly, to do estate planning, but this is a great reminder why it's important. If you are in those higher net worth levels and you find yourself breaching these dollar amounts, do estate planning ahead of time. There are things that can be done to help minimize this tax. So again, if you're only relying on a quick Google search on what taxes are going to be imposed to me when I inherit from my parents, your search might very well end right there. And yes, that is the case at the time of inheritance. That's going to be the taxes that are going to be imposed on their estate. But really, what you likely care about is, what does this mean for me? We have a whole other variety of taxes that could be imposed on you once you own those assets personally after they have been inherited. So that's where we're going to spend the vast majority of our time here, because that's what really moves the needle. So the first type of tax that could be applicable to the assets that you are inheriting once they're in your name is the ordinary income tax. The federal ordinary income tax depends on if you're single or married filing jointly. There's a variety of rates ranging from 10% as the lowest all the way up to 37% is our top marginal income tax bracket for ordinary income. And really, it's going to depend on where your total ordinary income lands each individual year. So again, depending on the type of asset that you inherit from your folks, it could fall into this marginal income tax system, and we're going to have to be aware of that. The next type of tax that you could be subject to when inheriting from your parents is something called long-term capital gains. Same type of concept, whether you're single or married filing jointly, that's going to impact the ranges of the dollar amounts that it applies to, and then also the rates. But you can see the long-term capital gains tax rates are pretty preferential to ordinary income taxes. So now we know once we have inherited those assets, we might not be out of the woods quite yet. Some of these assets are going to have a tax advantage by being inherited, and we'll go over what that looks like. Some of them are going to have some extra strings attached to them that your parents didn't have to worry about, but now you, as a beneficiary of those accounts in this case, you actually have some extra stuff that's going to impact when you withdraw from those types of accounts, and accordingly, what impact that has on your own personal income taxes. So let's dive into the different assets that you could potentially inherit and take a look at what exactly that means for your personal income tax return. So the first type of asset we're going to look at is real estate. It's one of the most common things that I see kids inheriting from their parents. Obviously, personal residence is like the most likely version of this, but a lot of times rental real estate is something that's passed down from one generation to the next. So the type of tax that applies to real estate is long-term capital gains. So this is the preferential version. It's not as bad as ordinary income taxes. So we're off to a good start, and we're going to sweeten the deal even a little bit further. So the first thing you need to understand is that when your folks pass away and that those assets go to the next generation, there's something that happens called a step up in cost basis. A step up in cost basis means that any gains that your parents would have had imposed on them if they would have sold that asset prior to passing away are essentially washed away. So let's go through the scenario of your parents at the time of their passing, their primary residence is worth $1 million. You don't have any need to keep this home, so you're going to liquidate it and take the cash. So here's what that might look like. The proceeds of selling that home are going to be $1 million. And let's say that your parents purchased that house for $400,000. Now let's go ahead and back up and imagine a year before your parents passed, they actually decided they were going to sell that house. For them, what this would have looked like is they have a cost basis of $400,000 and then the proceeds of $1 million. Because it's a primary residence, they're likely going to get an exclusion for a certain dollar amount. But really what we're looking at is any of that gain in between the cost basis and those proceeds is going to be a capital gain and subject to capital gains tax. Now, let's fast forward again to where you are today. You inherit that $1 million house. You're going to receive a $600,000 cost basis step up, which means you get the $400,000 that your parents had, and then it gets stepped up to the value on the date of their death. So if it was worth $1 million on the date of their death, you turn around and sell it for $1 million a couple of months later, there's zero tax impact for selling that $1 million home. That $1 million comes into your net worth in cash, totally tax-free. Pretty sweet deal. Now, if you're in the real estate investing world, some lingo that is commonly tossed around is this phrase, swap until you drop. And that's exactly what this is. What real estate investors a lot of times tout is that they can do something called the 1031 exchange and buy investment real estate properties, sell them, exchange them into other properties, and never pay taxes as they do this over the course of their lifetime. And then they pass away, still holding that real estate. And then the next generation inherits that real estate tax-free. So if you've heard that phrase, swap until you drop, that's what we're referring to here, is that step up in cost basis. Now, one caveat, this doesn't happen too often, but I have run across it with clients in the past, is that if the real estate takes a really long time to sell and there happens to be a significant delta in what the cost basis of that property is, even after the step up in basis and what it sells for, there could still actually be some taxes imposed. If you were to inherit a home, that same home for $1 million, and then for whatever reason held onto the home inside of the estate for, say, 2 years, and then you turn around and sell that home for $1.2 million, that $200,000 of growth that happened after your parents had passed away, that would be a taxable event. So again, it's not 100% of the time that the proceeds of real estate come tax-free, but 99% of the time, in my experience, what I've seen with clients, that isn't the case. So the next type of asset that we're going to take a look at is inheriting an investment account. So think stocks, bonds, mutual funds, ETFs, any of those types of things that you would see inside of a brokerage account. So again, we're going to be subject to capital gains, which is the preferential of the two types of taxes that we could be subject to once those assets are brought into our ownership. And again, similarly to real estate, we're going to have something that's called a step up of basis that occurs. Now, a little bit of a difference here is since real estate doesn't change in value more often than not on a day-to-day basis, and it's usually a wash at the sale, values on publicly traded securities fluctuate daily, hourly, by the minute. And so here we're actually going to see various tax impacts, even if you do liquidate these types of assets in the short term. And they could be good or they could be bad. So we're going to go through a real quick example. So in this scenario, let's imagine that your parents purchased $25,000 of Microsoft stock in 1995. Great pick, by the way. So they bought $25,000 of Microsoft stock in 1995 and they never sold it. When they would have passed away in the year 2025, the recording of this video, the value of that stock, if they held it all the way through, would be roughly $3 million. So let's assume that they were in the absolute highest capital gains tax rate, 20%. If they were to have sold that $3 million with only a cost basis of that $25,000 that they originally purchased for, they would have generated probably about a $700,000 tax bill. Let's go back to this scenario where they held it all the way through the time of their passing. They received that same step up in cost basis as of the date of their death. Those assets, the shares of the Microsoft stock, is passed down to the next generation. And that Microsoft stock can then be liquidated with a $3 million cost basis. And potentially, depending on the movement on the price of those shares in between the time of death and when the child can actually get around to selling those shares, 0% or $0 of capital gains tax for the next generation. So a massive, massive tax advantage, a massive, massive capital gain that was avoided by your parents by holding it until death. One of the questions that I get fairly regularly in working with clients who have folks that are towards the end of their lives is, hey, should I sell some of their stocks and clean up these old brokerage accounts just to make things easier for when they pass? And in most cases, the answer to this is no. The value that you receive by getting that step up in cost basis at the time of their passing can be massive. And by selling those shares before they pass, there's a good chance that you're going to be actually creating a tax bill that we could have avoided if we would have just left things alone. So the intent there is great. I love that folks are trying to be proactive and make things easy on their parents and on the estate and on their families when they pass away. But this is a move that you're probably going to want to avoid. Now, a quick caveat to this is if your parents do have losses, because for the same reason that you get a step up in cost basis at the time of death, it goes the same way if your parents actually have a loss in a stock. So I know this is, can be a little bit sensitive, but like if there are losses, that is a tax planning item that might make sense for them is, hey, should we take some of these losses while we're alive so we can have a tax advantage as opposed to losing them when we pass away? All right, the third type of asset that we're going to look at today are traditional retirement accounts. So the type of tax that traditional retirement accounts are going to be subject to is ordinary income. Now, the reason that they're going to be subject to ordinary income tax is because your parents got the tax benefit when they were alive. And here's what I mean by this. So the way that dollars get into traditional retirement accounts is you contribute those dollars in, whether it's through your company's 401k plan or maybe a traditional IRA, and you get a deduction on your taxes in that tax year. Once those dollars are in that account, they grow tax deferred. And then even for your folks, and then the same will be true for you, when you withdraw money out of a traditional retirement account, it's 100% taxable as ordinary income. This is the worst asset to inherit from a tax perspective, especially if you inherit these assets in your peak earning years. And here's why. Your folks, depending on their age, were likely subject to something called required minimum distributions. As of the time of this recording, the age that folks are subject to that varies. It started all the way back at 70 and a half several years ago, and now that has been kicked out all the way to the age of 75 in the future. But basically what it means is that they have to take out a certain minimum each year out of that account. And the reason for that is when, like I mentioned earlier, when you take money out, it's taxable. So fast forward to you are the beneficiary of a traditional retirement account. It is now in your name. It's an account for the benefit of you as the beneficiary of the retirement account. We now have potentially required minimum distributions, so the same kind of set of rules that your folks were subject to, and then also something called a 10-year rule. So what this means is from the date that you inherited that account, we now have 10 years to liquidate that account, which if you need the dollars is no big deal. But in a lot of cases, the clients that I'm working with are in their peak earning years when they inherit retirement accounts from their parents, and taking dollars out of a traditional retirement account stacks on top of your earned income. So the dollars that are coming out of these retirement accounts in many cases are at the highest tax rates that these clients are ever going to be in over the course of their life. So the optimal tax strategy for inheriting a traditional retirement account really does depend on your circumstances. If you're in your peak working years, the best strategy might be to take even distributions over the course of the next 10 years to do your best to keep those withdrawals in the lowest tax bracket possible. On the other hand, if you know that you're going to be retiring in 3 years, the strategy could be significantly different. We could be looking at doing something like taking as small of distributions as we can for those first 3 years while you're still working. And then after you retire, your marginal income tax bracket is going to drop significantly because you don't have that earned income anymore. And now we can really lean into making withdrawals from that account over those next 7 years in order to make it cleared out by the time we get to that end of that 10-year period. So again, this gets complicated quick. We want to make sure we follow the rules, and we want to make sure that we implement the best strategy possible for you and your family. So check in with your financial planner, check in with your CPA as you're making these types of decisions with beneficiary traditional retirement accounts. Now, the fourth type of asset that you could potentially inherit from your parents is the best. We're talking about Roth retirement accounts. So Roth retirement accounts, they're tax-free. We do have some of these extra rules that do apply to beneficiary Roth retirement accounts. But the reason that inheriting a Roth account is so great is you have all the flexibility in the world when it comes to a tax perspective, with the exception of we still have that 10-year rule that applied to the traditional retirement accounts that we just talked about. So with Roth retirement accounts, you can take withdrawals at any time. Zero income tax is going to be imposed on those withdrawals. So what this looks like for a lot of folks is if you don't need those dollars inside of that 10-year window, the optimal plan may be to leave them in there and allow those assets to continue to grow on a tax-free basis all the way until that 10th year, and then make that withdrawal in that 10th year. Roth retirement accounts, they're absolutely great. They're tax-free. If you find yourself in this situation, thank your mom and dad. Now, the fifth type of asset that we're going to talk about today, and this is the last category that we're going to look at, are insurance products. So the two insurance products that I see inherited the most are life insurance and annuities. So we'll talk about life insurance first because it's pretty simple. Life insurance is inherited totally tax-free. So we don't have to worry about ordinary income. We don't have to worry about capital gains. So you'll receive a cash disbursement from the insurance company, and then it's up to you what to do with those dollars from that point. So super basic. The other insurance product that we see inherited pretty regularly is something called annuities. Annuities are the only asset class that does not get a step up in cost basis at death. And so essentially what this is going to look like is whatever those tax impacts would have been for your folks, basically the same thing is going to apply to you. So whatever their cost basis was in the product that they purchased is going to be your cost basis now that you own that product. So the gains inside of an annuity are taxable as ordinary income. And then the cost basis, so what your parents paid into it, comes back to you tax-free. So it's going to be a combination of ordinary income for any of the gains that they had, and then tax-free for whatever they put into it. All right, this is what a lot of you have been waiting for. We've made it to the case study. So we're going to take a look at a mock scenario where a married couple inherit $1 million from their parents. And we're going to take a look at the tax impact on their overall plan and just how much they were able to retire early from the impact that inheriting $1 million had to their financial plan. And to sweeten the deal a little bit, we're going to look at two different types of asset classes and how much of a difference it makes to inherit one type of asset versus another. So let's jump in. All right, so we're going to just go over the blueprint real quickly here to give you an idea of the current situation of this mock scenario. So we're looking at Steve and Cheryl Smith. They have a net worth of a little over $4 million. Here's what it looks like. They have $125,000 in their checking, $100,000 in a joint investment account. They've both been saving diligently into their retirement accounts. They have traditional IRAs and Roth IRAs. Their home is worth $1.25 million, and they've got a small mortgage and a lake cabin. So just to give you an idea, this is the makeup of their overall net worth. Their ages 50 and 49. So right now over here on the right tab is their current plan. They have a 96% probability of success. And for them, what that means is that they are going to be able to retire at the age of 65, spending $13,500 a month in retirement. But in our mock scenario today, we know that Steve and Cheryl are going to inherit $1 million from one of their parents. So the question that they have for us is, okay, well, we know we're on a good track. We feel really great about having a 96% probability of success, retiring at age 65. Jordan, I'd really like to retire a little earlier, or at least have the flexibility to consider it. How does this $1 million of inheritance impact our ability to take a look at maybe calling it quits a little bit early? Age 60 has been suggested by them. We'd really love to make age 60 work. We can see that instead of a 96% probability of success, they have an 81% probability of success. Not horrible, still a good financial plan, but for them in their scenario and their risk tolerance, they want a little bit more buffer. 81 is just a little bit too tight for them. They don't feel confident that they can retire at age 60 with only an 81% probability of success. So now that we have this new injection of $1 million into their financial plan, the question is, what does that do? We are going to say that they inherit $1 million of cash through the sale of a primary residence. We don't get quite all the way back up to that 96% probability of success, but we get all the way back up to 94. And so this might be a conversation that we're having with Steve and Cheryl to saying, hey, things have changed. A year ago, we didn't have this inheritance taking place. Retiring at 60 was too risky for you. Fast forward to today, we now have more information. We know that you've inherited this $1 million, and this could change their plans and allow them to retire that 5 years earlier that they were hoping for. So let's look at the same scenario. And now let's say that instead of inheriting a home, which, as we talked about before, that is a tax-free event because we get that step up in cost basis, and then we don't have to pay any of those capital gains that mom and dad probably would have had to pay. We're going to go ahead and take a look at, well, what if that $1 million that was inherited was actually a retirement account? What if it was inheriting $1 million of an IRA? What happens is we go from an 81 only to an 83. So it has a much smaller impact on the overall financial plan because of how the taxes are imposed on that account. So still a great thing. It's never going to be a bad thing to inherit $1 million from your parents. Absolutely not. But I think this is a prime example of what it looks like and how the different tax implications of inheriting two different types of assets for the same dollar amount can mean two different things for a financial plan. Because in this scenario, these clients, they're age 50 now, they want to retire at 60. That 10-year rule is going to apply. And what that means is those dollars that come out of this $1 million retirement account are going to be taxed at the highest tax rates that Steve and Cheryl are going to see in their lifetime. Again, still a good thing, still a great thing. They're better off for it. But this just shows the difference in inheriting two different types of assets and the two different types of taxes that are imposed on them. So if this sounds like you and you're curious how the inheritance that you just received will impact your overall financial plan, scroll down to the description, click the link there. You'll have a direct link to my calendar. I'd love to hop on a meeting with you and see just how the inheritance that you have received impacts your ability to potentially retire early or achieve any other financial goals that you might have. Once again, I'm Jordan Curnutt, certified financial planner with Quantum Financial Planning. We'll see you on the next video.